the always brilliant Simon Belanger. How's it going, man?
It's going. Aside from a little bit of tech issues, going well. You?
Yeah. Well, it's I mean, people have heard us have tech issues live on this show, so
Yeah.
shouldn't be surprising. But yeah, I mean, it's growing pains with the pod switching video platforms, etc. But I mean, it never prevents us from getting episodes out, high quality episodes twice a week. So here we are. I guess three
Yeah.
times on your stream.
No, exactly. And I think it'll be a fun one. We just have a lot of stuff to cover. It feels like every week there's just a whole lot of stuff. I mean, we'll look at US CPI implication on rates in the US, but also obviously Canada, what it means there. I think you were going to look at what it's looking like for mortgages in Canada. I think some data coming out too that more and more homeowners are just underwater when it comes to the equity of their home and the mortgage. So they have zero equity, which makes refinancing a bit harder, and hiding your debt into your mortgage definitely harder than it would have been, let's say, pre-pandemic or even during the pandemic at historically low rates, especially when you're looking at 4.5%, whatever the rates are here. We'll talk about AI, a lot of circular financing, situational awareness, the collabs there, what it means for markets, making some pretty huge bets on AI. NVIDIA's announcement for $500 billion AI financing, where they're teaming up with some of the largest PE managers in the world, Apollo, BlackRock, Blackstone, Brookfield, and a few others. And that's, I think, pretty much it. Anything else that I missed, Dan?
No, I think I think that's everything. The piece on the mortgages, the other piece I'd like to talk about is sort of, we've mentioned a couple of times how like this debt burden could move its way into the consumer economy with lower spending, et cetera. And I think that seems to be what's becoming more apparent with some of the data that you mentioned we're going to talk about today, where, households could spend as much as 50% of their income. You couldn't go get a mortgage and qualify today if you wanted to go get a mortgage using 50% of your income. But on renewal, they don't ask. And so a lot of people are renewing into a greater portion of their income going towards their housing expense. And yeah, obviously, like the risks on the housing market, you don't have to ignore really, or sorry, I don't have to describe really, but the risks for me on households now having significantly less take-home income is kind of part of the theme that we've been discussing a little bit. And then, yeah, I mean, it seems also like, with US CPI and Canada, that rate cuts might be more of a conversation than hikes right now. Even, and I don't know what your thoughts are on that.
I don't think either is really likely. I think they're just going to be standing pat. That's and I can go over some of the probably things that they're debating, but for Canadian households, yeah, I mean, don't you feel like for homeowners, a lot of what's happening right now is just, let's just hope things get better? Like, I don't know, like the strategy is hope, right? Like, I don't think there's a real strategy.
Yeah, 100%. I would say that, like, it's funny, every time I post positive economic data, people in the comments say that it's like, government propaganda or whatever.
You're such a bull, Dan. You're such a bull.
But then whenever I post negative economic data, they trust the data, even though it's the same source. And, it's a reflection of where we're at. So I think it's interesting because we're seeing a lot of positive economic news come out of Canada, right? Jobs print was strong. GDP print was strong. You should feel like Canadians should feel like we're in a economy that's doing well, but they don't, right?
Instead, they feel like it's a vibe session, man.
It is a vibe session for sure. But yeah,
shout out to Chris Jeffrey.
Yeah, I think that we actually have vibe session t-shirts, which is pretty funny. But I think that the consumer sentiment, at least in my sector, is super important, right? Like, people don't go and make the biggest investment of their lifetime if they don't feel confident in the economy. So I'm of the opinion that how consumers interpret the data is just as important as the data itself. Sure, the bond market and whatever can interpret the data a certain way, but if the central banks hike or hold or like or don't cut as a result of the data that we're seeing right now, that's just going to delay any recovery that you might see, at least in my sector in the housing market. Obviously stock market's a different story with what's happening there, and I'm sure you're going to talk about it, but it's interesting to me to watch this all play out, because
Mhm.
people don't feel like nobody resonates with the data that they're seeing, that jobs are being added, or the economy, the GDP, Q2 GDP is going to track at like 3 point something percent annualized or whatever. So
Yeah, no one gives a shit about that when they're trying to buy a home, right? Like they're thinking about their prospects, if they think their job will be stable, and they're looking over their shoulder at their neighbors, and has the neighbor lost his job? Like that's what most people
yeah,
are looking at. Like we are the outliers, people watching us are the outliers. Like they follow the data more than probably 85-90% of the people. So I think at the end of the day, that's more like what is driving a lot of potential home buyers, is just what they're seeing with their own eyes, right? Like it's not,
yeah.
they're not digging into the data. They're just looking at it: is my employer hiring? Am I at risk of losing my job? And is my neighbor losing his job? And is that making me nervous? I think that's just how it is.
Yeah. Yeah, I completely agree. In housing, you can see it. Like housing numbers are bad.
Mhm.
The job side, I think like it's also somewhat reasonable for people to be, to take those numbers with a grain of salt. Like the I mean, StatCan LFS is frequently revised. StatCan has indicated that there are some discrepancies in the data with the non-permanent residents, which we mentioned in last week's episode, which could skew the labor force up or down significantly. And then the other piece is, we're looking at July labor force data. Well, there was a huge hire for the World Cup, and most of the jobs gained were in the province of Ontario. So that's probably where you would have seen a lot of those. So, like a lot of people say, oh, it's just seasonal jobs. Well, seasonal jobs would have hired in May realistically. And also the labor force survey is seasonally adjusted, so it shouldn't print a huge year over year. So I'm interested to see if the strong economic numbers hold in Canada. I don't think they will, to tell you the truth.
Yeah. I mean, I think even the US starting to roll over a little bit. I can't remember the percentages, but if you X out AI spend, it's not like the US economy is just firing on all cylinders. And we had the US CPI came in 3.4% year over year, 0.1 month over month, kind of in line with expectation. Energy was up around 15%. Both were essentially slightly down from June, energy and oil. So there was some downwards pressure on prices. So it was, I think, around 2-3% decline versus June. We'll have to see, because I think WTI, the price of oil, was around $80 per barrel in July on average. And we'll have to see what kind of impact August will have. I suspect it'll probably tick up because of energy prices. Food inflation stayed pretty low at 2.7%, shelter 3.2. Core was 0.2 month over month and 2.5 year over year. So obviously that strips out the most volatile components here. And oil is definitely the biggest wild card, but because I think I know you follow this, and I'll just share a tweet over here. So we've been seeing headlines, and that's been pretty continuous here, about the just strategic petroleum reserve just
Yeah.
being at their lows not seen in several decades. I think S&P 500, that was posted. This is more recent here, so it's down to 300, let's say below 300 million barrels. And if you look back here and look at this here, then S&P update. So that was July 15. So within a month, it's dropped from about like 20 million barrels. So they're definitely drawing down on it. At some point, they won't be able to, because they'll want to keep some kind of minimal level for emergencies. But that's another thing to keep in mind, because the International Energy Agency, so the IEA, said they project a supply deficit of 1.3 million barrels per day for all of 2026, because what there has been more of a supply deficit if you're looking just at pure supply, if you look at what's missing from the Middle East, but there's been some demand destructions. Of course, a lot of people say they're constantly wrong. That's fair. I mean, you have to get data somewhere from
Yeah.
from
Yeah, we have
experts.
well, it also doesn't matter whether or not they're wrong. Like if that's your thesis, then use that, and it's still an indicator, right? It's just an
Yeah.
indicator that to the opposite if you're fading that thesis. So, I mean,
Yeah.
I'm like
And
that with bond yields. Like I literally am like, I usually would assume that bond yields or Fed fund futures are less or like that you should actually trade the opposite of what they're saying. And the same with Canadian consumer sentiment. Like if Canadians are
yeah.
piling into a trade, usually the opposite trade is the right trade.
Yeah. Yeah, same probably for AI right now. We'll talk a bit about that. But and then again, we talked about the straight. We won't harp on it too much for what's happening in the Middle East. But how many times will be like fake pump or whatever you call it, in terms of, or job owning in terms of a deal for the straight? Like honestly, at this point, like how many times has it happened? Like 15 times? Like I've lost track.
Yeah.
And the straight is still not full. I don't think it's really open. I've kind of lost track of what's happening all the time, but you can make a case that $80 per barrel is probably the floor at this point if there's no resolution, and I don't
Yeah.
see really the U.S. or Iran really wanting resolution anytime soon. So, where I'm not an expert in the Middle East or anything like that, but that's upwards pressure. And in the U.S., you talked about, I think last week we talked about the jobs report. Canada came out with what, like 80K surprise? Like what was the number? Do you remember?
75, yeah. And it was
70.
a lot of private sector, a lot of
Yeah.
self-employed. Now, like self-employed category is interesting because I think that includes like gig workers, like and stuff like that, the way the technical.
Mhm.
But because you're technically third party contractor, but so maybe a lot of people picking up Uber jobs. I don't know, but the most fascinating part from Canadian jobs was that public sector employment as a percent of total and public sector employment period has actually fallen on a year over year basis for the first time in like 26 years since the year 2000, I believe.
Mhm.
Um, yeah, I don't know if you do follow the Hormuz traffic thing. Like it's pretty
Once
crazy,
in
man. Like
Yeah, once in a while, but haven't looked at it in a
yeah,
couple
it's like
weeks. Yeah.
I mean, it's basically like
Yeah,
it's
dried up.
there was a yeah, like yeah, like Trump says the strait's fully open. It's like yeah, it doesn't look exceptionally open there to me,
Yeah.
but
Looks
I
like
don't know.
Toronto traffic. It just
Yeah,
goes to a crawl. Yeah.
yeah, yeah. So
Um, no,
I don't
that's a good point there. And I mean, just on the jobs number, I don't know if you saw the US job report. So they had massive revisions too when they
yeah.
came out with it. So they lost 20K jobs in July, but that was also there was also a revision downwards of 100,000 jobs. So it's not like the US is firing on all cylinders right now, especially if you start Xing out AI spend in the economy. And if you're looking at bond yields, I think the 2-year bond yield is around 4.15%. So still pricing in like some rate hike. Yeah, there you go. So 23,000. I knew it was around that amount. And so you have the 2 years that's pricing in potentially, like it's a good proxy for what the market expects the Fed to do, so slightly higher rates there. The 30-year, we talked about that. I think you sent me something about the 30-year and I'll show it here. So it reached levels not seen since pre-financial crisis.
Mhm.
um, so I think it was the highest level, 5.27% on the 30-year note, highest level since 2007. So I was trying to show here.
There we
There
go.
you go. From the Kobisi letters, and it's pretty close to that level right now. I think it's down maybe 5-6 basis point, around 5.2. I don't have it on my screen per se, but why I'm talking about that is the US debt is getting more expensive to refinance on the long hand. That's pretty meaningful because Government Accountability Office in the US said, as their projections at the start of the year, there'd be around 10 trillion in debt that would be refinanced in 2026. So it really puts the Fed in a tough situation because if you raise rates, you slow down the economy, there's more job losses, you increase refinancing costs. Hopefully, you slow inflation, but it's not sure because it's driven a whole lot by what's happening in the Middle East and higher oil prices. Hopefully, you stabilize long term yields because that's what they want to see. They want to see you tackling inflation, amongst other things. Could also have a negative impact on other foreign currencies like the yen, for example, because if you increase interest rates, the differential goes up. So that could create some other problems. Clearly, the US is concerned about the levels of the yen. They would not have intervened if they were not. If you lower rates, you stimulate the economy. There's more jobs, potentially higher inflation, though, likely higher yields on the long end of the curve, because then bond market starts punishing um, the Fed for doing that, because they start demanding higher yields because they're worried about inflation longer term. So really, the Fed, when you think about it, is stuck between a rock and a hard place. Like, they're really not in much of a position to start raising rates. And then you look at Canada, and you know this as well as I do. So if the BOC starts lowering rates, sure, if they want to help homeowners, go for it, lower some rates. But hopefully that helps the economy. Who knows? Because it does nothing for tariffs. It will likely weaken the loonie if the Fed doesn't do anything, increases potentially inflation as imports get more expensive. It might stimulate the economy, but we'll see. If they hike rates, then homeowner gets hit harder. The loonie might get stronger. Who knows? That's kind of hard to say. The economy slows even more, and unemployment rises. The tariffs don't go away magically, and hopefully inflation stays around the target. So it's basically like the options suck. Like, that's why I think they're just going to stand pat.
Yeah, I would agree with you. I think that there's no data significantly enough. There's too much volatility in the data. One, like you have, up and then down and then up and then down, GDP up, jobs up, down, like, so there's too much variance, too much volatility in the data points that they'd be using. There's no trend. Like, if you were concerned that inflation was running away, it would take a couple of months for you to make that decision. And I mean, maybe if we use COVID as a comp, where, because they've said that oil price inflation, would be transitory as well. And
it's the word of the decade.
Transitory. That or uncertainty, or unprecedented. Sorry, but I think they are waiting for a more clear trend on data, and there isn't one. And I do think that if one evolves, it's more likely that we'll see a downtrend than an uptrend as a result of kind of like K-shaped economy. The lower class really suffering as a result of a lot of this stuff happening right now. But I could very well be wrong. Like, the AI CapEx spend could keep pushing the US economy up. This circular financing could end up actually delivering results for all of the parties involved. And
or blowing up spectacularly in their faces. But
but maybe we do get huge productivity gains from the AI stuff. Like, there is a bull case to be found here. I just don't know if I believe it as much as, like, you still need people to be able to afford to consume stuff. They still need to be able to pay for ChatGPT if if these companies are going to make money when they IPO.
One thing I heard, and it's a good point. So have you ever thought about all the financing required for AI, all this compute?
Yeah.
And at some point, there's just limited amount of capital, right? So how much of that financing is starting to take away from demand for government bonds? I think that's a good...
Well, this is a big part about, like, the IPOs coming up, right? Because you hear about, like, I mean, so SpaceX, is it back at all-time highs? It was at some point.
Oh, no, not even close. No.
Are you sure? I think it is.
No, I'll guarantee you it's not.
No, I'm almost certain. I can't wait to be right on this one.
Above the IPO price, but it's it's 140. So the IPO'd 135, and it peaked around 215. So it bounced back, but it's not anywhere near all-time highs. Yeah,
but it's it's up like 40% in the last couple of days. I guess
5 days. Just looking at the 5 days here.
This reminds me of, like, early. This is a new Tesla, like, Wall Street bets trade, man. Like, it feels like the just the volatility. Like, you're getting 10-20% swings, right? But they did launch an exceptional model yesterday with Grok 4.6, and they launched Grok Bot, which I've had a chance to play around with, which is crazy expensive, like $450 a month. I think you have to pay for the for Grok Heavy, but I had to, because I got to test it, to see how people can use it in my industry. Because we do a lot of content on that stuff, because we build AI tools for real estate professionals. And
is it good?
It's good. It is. It's definitely the most user friendly of all of the labs are pivoting towards harnesses now, right? Everybody says, like, oh, OpenClaw is dead. It's like, well, OpenClaw is dead. It's not dead. It's everybody is building off of the idea of OpenClaw now, right? Which is it doing its job. And I think it's interesting. Like they're all becoming harness companies, right? They're trying to create practical uses for the AI compute, and whoever gets to the point where they can build this kind of like proper interface for you to execute tasks on your computer. I thought Microsoft or Meta or Google would have had the easiest time getting into the harness game because they already have the active users. You just plug it in, but none of them are really doing a really good, exceptional job at it. So now you've got three new players to consumer tech, like so to speak. X probably has the best user base to pull from with the way they integrated Grok into
Yeah.
Twitter. But so that's probably pretty bullish on that stock. But I agree. Like I took a big tangent there, but to the IPO stuff, like when they IPO'd, you saw everything else kind of draw down a little bit because
Mhm.
all that retail capital was chasing the new trade. And it's going to be the same thing when I think Anthropic's supposed to IPO sometime in September, October. I think it's October now. So
Yeah, but now you also have the hyperscalers that are issuing debt and equity, that is pulling capital from the markets. And I think
mhm,
it's making governments and the US government nervous. Like, why else would they have intervened to try and prevent Japan from selling US treasuries? Like, they're nervous about the level that the long term yields are. And they
right.
don't want it to go too much higher because then if it does, they'll probably be stuck at just issuing on the shorthand, and then at some point that becomes a problem because then the Fed, like, they can't raise, right? Like, they have to
Mhm.
keep rates as is or lowering them. If not, the interest expense just gets too high. So that's
Yeah.
why I was kind of getting to that earlier, is you're like, you're damned if you do, damned if you don't.
Mhm. No, it's a good
Fiscal
point.
dominance. Yeah.
Yeah, I mean, it is fiscal dominance, right?
Yeah.
And if they keep issuing tons of debt, then
Yeah.
they're unintentionally and unfortunately very much on the um, you know in control of the yield because they're dictating what consumers are willing to or sorry
Mhm.
what bond investors are willing to pay.
Yeah.
Um,
So did you see that Nvidia 500 billion AI financing plan?
yeah, like I pulled up the circular financing
Oh
graphic,
man,
but yeah, I mean it is getting crazy. Like it does kind of
it's
feel like GFC stuff a little bit, right? Like, and a lot of people would argue like, oh, it's not the same because this is a new technology and it's economically productive and it's going to drive productivity. It's like, well, people felt that way about the housing market ripping too. Like that, ask me if a contractor felt like that was economically productive in 2006, probably, or a realtor or a mortgage broker or a bank. Like there are other sectors. This is not it's becoming a large sector, but it's not a massive sector before this game started. But all this cross collateralization, you create this like huge issue for if one of these players ends up in a bad position for the systemic or contagious exposure. I think like, I mean, this was one of the issues that I had with Bitcoin. Like this was one of the reasons I really, really got sour on Bitcoin, which I told you guys about, you and
yeah.
Braden. I was like, I really think that Saylor like killed the spirit of Bitcoin with all this like cross collateralization, and it's centralizing and it's being offered to government sovereign wealth funds are purchasing into it. The spirit of it has been gone, but also it's been like centralized and risked and stacked upon. And I think the AI trade didn't need to be this, but here we are. It's because like everything just turns into a casino in the US. So anyway,
Yeah.
I'll let you. I
And
want to hear
you're
you take.
getting, and really the ground zero for all of this, I think, would be like, it all starts with OpenAI and Tropic. I think if one of them fails or both fails, and you can raise some question, we don't fully know their financials, but based on reports, they're losing tons of money, and they would not be raising constantly, like raising cash every like 5 to 6 months, if not that, at record valuation, record amounts. If they were producing cash flow or break even, they would not need to do that. So that is a big concern there. So Nvidia, they came out with that 500 billion AI financing plan. So it's a plan with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, KKR to mobilize essentially 500 billion in AI infrastructure, in terms of a fund that would, I guess, invest in that. It's not a 500 billion Nvidia fund. It's really, the goal is to bring private equity into it, private credit, pension, institutional investor, almost like create like as an asset, investable asset class with future returns, like almost like a toll road, which is absolutely ridiculous when you think about the lifespan of a GPU. But I digress. Nvidia is helping to help the fund de-risk, so they could backstop up to 25% of the financing, potentially around 125 billion. And they've already done similar things, and that's where the circular financing gets a little worrisome. So you have CoreWeave, where they have, you can look that up, it's an official filing. So 6 billion capacity backstop if CoreWeave doesn't sell all of its capacity. They also invested 2 billion in CoreWeave, who is an Nvidia customer, of course. Nvidia also invested 30 billion in OpenAI equity earlier this year. Of course, OpenAI needs compute, and then they'll be renting that compute from some of the hyperscalers, who, guess what kind of chips they're mostly buying? Nvidia chips. And there's also talks that Nvidia is looking to backstop 250 billion of financing for OpenAI to lease compute for a data center that'll be built by SoftBank. So of course, the data center, I'll let you guess what kind of chips that they'd be using. So it is like, it's pretty
But I
crazy.
think
And
Nvidia kind of has like it has the like monopoly on this, because everybody has to develop on this like CUDA platform that they've created, right? Like it's not just because of that. It's
in
also because
part,
of,
yeah. There's been competing chips. I think the TPU Google came out with. I think Meta also has a competing chip as well. And the problem is then when you start looking at the hyperscalers, is they're not very straightforward on their AI revenues, and also who's generating most of the AI revenue. But most of the estimates now that we're starting to see, and Steve Eisman from The Big Short, by Steve Carell, I think he was playing The Big Short.
Mhm.
He has his own podcast. He goes on CNBC once in a while, and I did some digging here, and based on some internal memos from example at Microsoft, but you can also kind of piece some things as you could be looking at OpenAI and Anthropic accounting for as much as 70% of the AI revenue from Microsoft, Amazon, AWS,
Right.
Google, and Oracle. So that's why I'm saying, like, what the hell happens to growth if these companies go under and they can't get any more financing? And then you have the issue that, okay, and then you have these hyperscaler that are spending billions buying NVIDIA chip to provide that compute infrastructure. So that comes back to NVIDIA. So it's really, there's definitely a circular thing. Like there could be a massive ripple effect if something goes down here. And that's why, like, that is, to me, that's a big concern. The market seems to be disregarding those risks altogether. I mean, these companies are just burning so much money. It's absolutely insane. And they're being relied upon for growth for companies that, like these, so NVIDIA, Microsoft, Amazon, Alphabet, Broadcom, Meta, and Micron, so all tied to the AI trade, they account for 29% of the S&P 500.
Have you seen this
Yeah.
like the table on like how much compute you get per plan? Have I showed you that? I think I pulled that up before on this. Check this out. Like if you buy like because I just wanted people to
Yeah.
understand the magnitude at which they are incinerating cash, because
Oh, yeah.
I don't know how this ends. Like to me, there's a couple of ways, but one is they actually are efficient at reducing costs of the models over time, and it seems like we're kind of progressing in that direction. Like we've sort of reached an upper end of how much they really want to develop to super intelligent. Like I think Fable 5 really showed the market, or showed the producers that like the consumers who are going to spend money on this stuff don't really need super intelligence. Like I don't need super intelligence. My job is
No.
pretty simple, and I like using AI for my job. I don't really use it for anything else than that. I don't use it in my personal life or any of those things. So why do I need the, like the smartest model ever, or the closest thing to AGI that we've ever had? I don't, right? I need something that is cheap and reliable and specialized. And that is what it seems like you're starting to see Grok and DeepSeek, like a lot of the US or the Chinese competitors coming in the market trying to lower the token costs. Maybe we get to a point where in a year or two, token costs are enough that it actually people can use this at scale, but then the perceived margins that, that we had on these businesses are also going to end up shrinking as a result. As it stands right now, just to reference the table on the screen, and then I can pull it down. If you buy a Claude Pro,
Well, let's be clear, they have no margins right now.
right? Yeah, their margins
Yeah.
are deeply negative. Yeah,
Yeah.
but on API cost, right? So assuming
Yeah.
you're actually paying them at cost. But if you're using the Claude Max 20X plan for $200 a month, you're using $8,000 worth of compute. And that's like, and you can feel a distinct difference if you use Claude versus ChatGPT, how much more compute you get for ChatGPT, because they have, Dario is famously quoted saying that Altman's approach to compute was very YOLO and he didn't think it was going to play out, but they obviously have way more compute ability. And so you spend $200 a month with ChatGPT, you're getting $14,000 a month worth of compute. Like, they're subsidizing your spend to the tunes of like, what, that's like almost is that 70x magnitude, 700x? I don't
You'd
know.
have to
My
pull it
math is
back up, but
horrible.
it's a lot. But how do they make money? I
They
still
don't. They
don't
lose it.
understand. Yeah, yeah,
They
exactly.
raised. Yeah, you're right. And then SpaceX, I think, is an interesting case study in this regard, because it's like they've IPO'd and it doesn't really seem like the market cares that much that they're not
Yeah,
making
but
any money.
they're selling some of the compute that they're not using. So I
Right.
think that is padding their losses a bit right now. It could be a whole lot worse, but I think OpenAI and Anthropic are using everything they can use. So they're not in
Yeah.
this a position that they can do that.
Yeah.
And so what do
They're
they
not
do?
as
Do they
vertically integrated, right? Like they
no,
just make models. They don't launch data centers into
exactly.
space.
That's it.
Yeah.
So what did they do? They jack the prices, then everyone goes to the cheaper models, or they try to be more like I don't know how they make money. Like every way you start thinking about it, they just lose a lot of money or a bit less money, but they still lose a lot. Like I just don't understand how they can become profitable.
I agree, and I like unless they go to API only. Like at a certain point, I think we're gonna get to consumer plans are
Mm.
probably gonna go away, and you'll either pay per use or you'll have fixed costs that are actually. It seems like they're all hoping that they can get their costs down at some point. Like models are getting more efficient with CoreWeave, that new like 10x announcement with NVIDIA. They are getting more efficient at running the models. I think the models are becoming leaner and like better at accomplishing the job with less compute required. So I think that there are a lot of like positive catalysts that could make the economics of this whole thing improve slightly. But I
Yeah, I
agree
mean
with you. I don't
it's
know.
all it's almost like me, right? Like people watching the live. Like I don't have a whole lot of hair, and I can keep hoping that I get more hair, but it's not going to happen. So it's
Yeah,
maybe if I put some
I know,
Rogaine,
same.
it'll grow
Everybody
slightly.
comments on it on my on Reddit, and I'm like, there's so many people that care more about my hair than I do. I appreciate it. Thank you for the.
Yeah, yeah, no, but no, I think that was kind of the gist of it. Not to go harp on AI for too long, and then the whole situational awareness collapse. I think I just wanted to talk about that
Yeah,
quickly. The fund went from 1.5 to 20 billion in AUM. They were basically using leverage to bet on AI winners, including chip makers. They were also shorting SaaS companies that could be disrupted. So essentially, it's the same trade on both sides. Okay, yeah, sorry, it was 45 billion. I saw some numbers of 20, but 45 billion. But essentially, they were doing the same trade twice, right? If you're going long and leveraging that on the AI winners, and then you're shorting companies that will get disrupted by AI. So if the AI winners keeps ripping, well, the ones you're shorting are probably going down, so you're winning. But if the inverse happens and AI winners go downhill, the SaaS stocks that were beaten up are probably going to start going up, and then you just get essentially what happened with them. And I think to me it's just this shows like this was a 25-year-old kid, I think 25-year-old that had no experience in running a fund whatsoever, a hedge
mhm.
fund, which not really hedging
Was
whatsoever.
he 5x levered? Yeah,
Yeah,
well,
it
obviously, it
was.
wasn't hedging if, like, one down day took him down completely, right?
Yeah, and I read reports that he went to New York and was trying to get some investments before it imploded a couple months ago, and apparently he didn't have an answer in terms of the questions being, well, what would you do if the AI trades reverts back? And he had no answer for that. And it's just a good, I think it's just really insightful at looking at like how a whole lot of the market is acting right now, especially retail traders. They just don't think this trade can go away. And I think that's just a very dangerous situation to be in where people just put risk management completely out the window and they just go all in on this trade. And I fear that that's what we're seeing a whole lot right now.
Well, what did Greenspan call that during the last time we saw a detachment on price earnings this high? It was irrational exuberance.
Exuberance. Yeah,
Yeah.
you got it. Yeah. So that just to kind of tie that back up in the whole AI trade, but we had a few questions about real estate that I know it's right up your alley. So
Well, this is actually just one of the bulls that's on my. I'll pull this one back up. It's just one of the bulls that watches me on YouTube, and he loves buying real estate in BC. So he said, "What a great time to buy BC real estate." I mean, you're not. I feel like you're not far from your BC and Ontario catching a bottom, but I think there's still a little bit of pain left in the market. It doesn't mean you can't get good deals right now, right?
yeah.
So there's another good question here, actually. Shout out to Lilo. Besant said K-shaped recovery is over. LMAO, please discuss. Did you see that? I gotta pull this up. It wasn't.
No.
I remember seeing it. I meant to do something
Yeah.
on it. But,
What else is he gonna say, right? Like he's probably he was saying like he's gonna say that everything is sunshines and lollipops and going well. Like he's still a political figure. So
yeah, 100%. Oh well, let me share my screen for some reason here. Let me try again. There we go.
I went to Syracuse. I can tell you that if it's over, it's definitely it's not visible. That's for sure.
Yeah, I mean, it's pretty clear that the US and like especially this AI capex trade is very much distributing wealth upwards and taking wealth away from the bottom end of the market. So like I don't know. Yeah, I mean, it's very hard for me to agree that the K-shaped economy is suddenly over. Yeah.
He was also the one that was criticizing Yellen for financing most of the refinancing of the US debt with the short end of the curve, and now he's doing the same thing. So I mean,
yeah. There's another good one here. This one just came in from Joe in the Six. Shout out to Joe. Jobs are strong. Come on, look at wage increase and mostly part-time jobs. And then most of the strength is in Alberta and Saskatchewan, 10% of the population. I think I put some charts up on this on my Instagram, but basically, I think it was like cumulative job growth is like the vast majority of it is happening in the prairies. I'm not complaining about that, by the way. Like the more that we can diversify Canada's economy into those sectors and the more exposure that we're getting to those sectors, I think that's a good thing. Like I agree that I don't really think that the job sprint in Canada is strong. And I maybe they're earlier in the stream and watching the recording and they didn't they didn't catch like our full commentary on that, but a lot of it's probably skewed by FIFA. There is a lot of part-time, there is a lot of self-employed, and the way that we group those are a little bit unreliable per se. I think like with the gig worker stuff I mentioned, independent contractors, etc. But
it's a good chart here. Like kind of aligns with what he's saying. Yeah. So that's July 2026 is the unemployment rate. So you can see the change. And yeah, you're right. It's mostly concentrated in a few provinces. I guess Ontario was better than I thought it would be, but probably because of the World Cup. But yeah, you see that the biggest changes tend to be in those smaller provinces.
Yeah, I gotta find it was a Ben Rabideau chart somewhere on the jobs basically being. I'll just pull it up from my Instagram when I get a minute here. But I mean the reality is that the like job, sure, majority of job growth is happening in natural resource sectors. The GDP report said the same thing, right? It was an increase in exposure to natural resources, oil and gas, and mining and metals were like the biggest growth factors in Canada's economy in the strong GDP print that we had. These are good things. Like I've been sitting around complaining for the last decade that we were ignoring these economies, and they were one of the greatest opportunities that we had in our country to actually create some meaningful economic growth. I'm not going to be upset now that we're actually seeing it,
Mm-hmm. No, exactly. No, I mean, I think, look, it's I think what we were mostly saying is the job numbers don't like, they're not looking as great as maybe the last job report in Canada, and we were also saying that the US job numbers are definitely not as good as a lot of people were anticipated, and now we're seeing some revisions. I wouldn't be surprised if we for August we see a job losses in Canada. I wouldn't be surprised at all,
For sure.
especially
Yeah.
if you factor in those kind of seasonal hiring, especially with the World Cup being over.
Yeah, I
I
think the
wouldn't be
FIFA bump
surprised.
is
Yeah,
probably a
yeah.
real thing for sure. Yeah, and I
Mhm.
don't think one jobs print or one positive GDP print is gonna give us a lot of like it doesn't give me. It didn't even seem like the bond market really bought it. You know, like all of the improvements that we saw in bond yields kind of got erased within a short period of time. Like the bond market was basically saying like this isn't really real growth, but right, it takes takes a little bit for them to kind of come to terms with like, yeah, Bank of Canada is probably not hiking because we had one job print. Why? Because Canada's economy isn't strong. If anything, we need stimulus, and you need rates to come down because we're so indebted. And Canadian consumers are tapped out, and we talked about how we're going to get into mortgages on that a little bit, but mortgages, like a lot of people resetting at 50% of household income. Like there are way more things negatively on individual households that are factors in the economy right now than things that in aggregate are happening to the country, industries that are growing that could offset it. So I think that, like, to me, the picture is, it's not massively bearish, but I think the picture is pretty bearish for Canada, like relatively bearish.
Yeah, I mean, it feels like we'll be in a period overall, and knowing that real estate is very regional and very market specific, but it does feel like we might be entering for a long period of where prices are kind of just going sideways for a while.
Yeah, yeah, for sure. Yeah, I think there's going to be, I just don't see a positive economic catalyst for Canada's economy
Hmm.
other than rates coming down, which is like, rates have to come down because of a bunch of negative economic catalysts. So careful what you wish for with that one.
Yeah, but then, like we talked earlier, like you start lowering rates, then what's the second order effect, right? I think you want to help this industry, but then you start hurting other parts of the economy. Like, it's not an easy thing. Like, until the Fed lowers rates, I just don't see the Bank of Canada. I think they'll be too scared of just hammering the loonie. And if you start losing the currency, starts getting out of control, then you have to hit the panic button, and then that doesn't look all that good.
Yeah. Yeah. 100%. Yeah, I think it's easy for, like, I guess the difference in Canada versus the US is, like, obviously Canada, I can't see the Bank of Canada really doing anything unless the Fed has to make a move. Like, I think that they're just going to hold, and really the Fed's the one calling the shot. But I think the difference in Canada is our household indebtedness, right? And I'll pull up this chart that I always reference whenever it comes out from Desjardins about Canadian household indebtedness. I think I've mentioned this a couple of times on this stream, but I mean, household debt in Canada came, we topped it, I think 188%, and we're climbing again. We hit a bottom. It looked like Canadians were deleveraging a little bit, and now we're back at 180%. You go compare that, like look at Canada versus the US, just because those are the two that we're talking about in the way that the rates interact with one another. US is, I mean, still high, 100% debt to household income, but interest rates aren't as stimulative in just saving households from their debt burden as they would be in Canada, because they're not as irresponsibly levered as Canadians. I mean, taking on debt in Canada is our national sport, right? And so I think that that's something that the central banks are also probably paying a bit of attention to.
Well, you had 2 years. I think we mentioned it a little bit where people were just tacking on high interest debt onto their mortgages, onto their home equities, right? Because they could tap in, they could refinance. I think, didn't they just increase the refinance requirement where you needed to have more than a certain, like, was it 80% to be able to refinance or have a HELOC or something like that, and was lower than that, or you
Uh,
could go
yeah,
higher than that prior?
65 LTV is
Yeah.
what you can do with a HELOC. There's been a handful of constrictive lending changes, I would say, for yeah, for Canadian borrowers on the mortgage side. Stress test is still intact. They've changed the loan to income requirements slightly across the bank's entire portfolios. So banks have to hit like if you take all of your borrowers and all of their incomes versus all of their loan sizes, that can't be greater than 4.5x%. So that's constricting. Banks are obviously starting to be selective about what high loan to income loans they're putting on their books, because there's a limited amount. I think it has to be less than 18%. I want to say is over 4.5x. So there's a lot of stuff happening. This is just credit contraction. This is what you see take
Yeah.
place in a kind of a recessionary or even just like a contractive housing market and cycle. Is banks are trying to de-risk, regulators are trying to de-risk, and the most prudent way they know how to do that is by forcing borrowers to take on less risk, because borrowers are really at the end of the day, they're the irresponsible ones. Like, it's so easy for us to say, oh, it's policymakers' fault. I know I saw somebody in like one of my Reddit posts yesterday. They were like, oh, this country has ruined my family's finances. It's like, I think you might have played a role in that personally.
Yeah.
Like, it's funny. Like, we
So
just have no
what
sense
is he
of what's
hoping that
going
just
on.
the government just
I guess we get
holds
a
your hand
bailout,
for
right?
everything?
Yeah, I don't
Yeah.
know. So it is funny
Yeah.
because, like, this is one of my gripes with the conservative movement and the direction it's heading in Canada, as somebody who has been that way for my whole lifetime, is there's no, like, they're always blaming, and it seems like a systemic issue in Canada and the US now, where people are just blaming politicians and the economy and whatever for their individual circumstances. It's like, well, what about the principle of personal accountability, right? So this is just
Yeah.
very interesting to me, and I
Who
think,
blames a lot of other people? Like children.
yeah,
That's how kids act. Yeah.
yeah.
Sometimes you just have to take ownership. You did some mistake.
Well, and with
Um,
personal finances, like, that's
yeah.
the personal in personal finances,
Yeah,
right?
exactly. Like your personal life too, right? Like wherever you're at, like you have to take ownership. You can't start blaming the world for everything that's going on. And I think, to me, one thing I've been pretty vocal about is just having better education for personal finance in our education system.
Yeah,
There's just not much that's given. People are not really aware, and I think that would go a much longer way than just saying, "Oh, regulators screwed us over," and blah blah blah. You know what would do a whole lot better than trying to get regulators to fix everything is to actually have a better education program when it comes to personal finance, because then people would actually be like, okay, well, is it a good idea to spend that much on a house and have so much of my income? And what happens? Like, people would actually start making those kind of um, calculations. First of all, being able to see if they actually afford it with all of their other expenses, but they would probably be able to see a whole lot of bullshit that, for example, realtors were selling in 21, 22, where if you don't buy now, you'll never be able to buy.
yeah. There's an interesting one on Instagram. It says, as a mortgage broker, reverse mortgages are becoming more and more
Mhm.
popular. Pensions no longer covering living costs. That generation focused on paying a mortgage, not investing outside of it. Totally true. I think this one's like very interesting. I think this is will be one of the defining pieces of Canada's housing market for the next 20 years, is baby boomers, how they're consuming their housing wealth, what they're going to have to do to liquidate to afford to retire. Are they going to sell and maybe become renters, like, because they don't want the burden of home ownership anymore, and want mobility or whatever? And then, like, are they going to be using debt against their houses to fund retirements? Reverse mortgage is a huge thing
Yeah.
that we're seeing, like, big trend. I think they're hitting record highs right now. I have to pull up the chart, but I think reverse mortgage balances. Um, let me find it. Anything else you wanted to go through on today's episode?
No, I think that's about it. Maybe on the pension part, that's a part I know well. I think pension, yeah, it really depends whether people are relying solely on CPP, old age security, if they have a private pension, and then private
Mhm.
pension. If you start looking at those, some are fully indexed, some are partially indexed,
Yeah.
some are not indexed at all. Some are defined contributions, which is essentially an RSP matching with the employer. So there's no guaranteed income. So you have to be able to meet with a qualified financial planner to have a good plan, or plan it yourself. So I think, yeah, the pension side, it's I don't disagree with the person saying with that, but I think it gets a little more complex where there's not all pensions are created equal. Some are much better
Yeah.
than others, but it is definitely those fully indexed defined benefit pension where you're promised a certain amount for when you're retired based on your usually best 5 years or something like that, a formula and a certain percentage for each year. Um, those those pensions are becoming less and less likely. So people are relying even more on either their homes or other investments that they would have. But we know as Canadians, a lot of Canadians just have most of their wealth in their homes.
Yeah. Yeah, I think I do have some charts on like wealth concentration in Canada, but we will cover that in another episode because
Yeah.
I think I've been wanting to. We've talked about this a couple of times, and just the debate of like stocks versus real estate,
Hmm.
and in Canada we love using our homes as our primary residence as a wealth creation vehicle, but it's not always the best deal for most Canadians. It makes sense because Canadians are horrible at saving money
Yeah.
statistically and
Forced
horrible at
saving
investing.
program.
Yeah. Yeah,
Yeah.
force savings
Trademark
into a hard asset.
Dan Foch. Yeah.
Yeah, into a hard asset that is illiquid. Like it's difficult for you to sell.
Yeah.
So this is why I think it's done well for people. But that's like really more of a behavioral. They're buying a behavioral, constriction or limitation rather than anything else. So we'll touch on that, and I'll bring some data on, household, because it's not that different in the U.S. as well. Like U.S. If you look at your vast majority of households, it's mostly wealth concentrated in their primary residence. I think it's like 60% of their wealth below, or like of the bottom 80% is concentrated in their household. If you go to the bottom 50 or bottom 70%, it goes up to like 80% of wealth. Because as you get richer, your primary residence becomes a smaller and smaller portion of your
Yeah.
net worth. I have some cool charts on that too. So anyway, we'll cover it all next week because I think we're at 1 o'clock. So
Yeah, no, it was a fun one. We'll be
was a
back
good one.
next week, and thanks everyone
Thanks a
for
lot.
showing
Yeah,
up.
this was a lit thread. We've been dealing with the summer. Everybody kind of out for the summer, so it was good to see everyone on
Yeah,
the comments here. We had tons of questions and all that stuff. So I appreciate everybody tuning in, and keep it coming. And we'll see you again next week.